Bitcoin did act more as a risk-off asset. A risk-on asset in the market's recent correction. It behaved like the NASDAQ, unlike gold. But we believe that it was just correcting to this trend line because the Bitcoin price went up so much more than the gold price last year. So we think that this trend line will continue to move up if we're right that we're moving back into a risk-on environment. We think that we're being set up here for some important surprises to the upside, as many strategists and economists worry that we're heading into a recession.
Cathie Wood weighs in on a growing concern among market bears that we may be on the verge of an inflationary bust reminiscent of the economic turbulence the U.S. faced in the 1970s and early 1980s. According to this bearish narrative, key indicators, especially the breakdown of the S&P 500 relative to gold, are flashing warning signs. The pattern mirrors historic signals from past inflationary eras, and many interpret it as a loss of confidence in fiat-based equities in favor of hard assets like gold. But what does this really mean for investors today? And how does it impact crypto, equities, and MicroStrategy? Stay tuned as we break down what's happening beneath the surface and why this moment could be more of an opportunity than a crisis. If you're passionate about markets, crypto, and MicroStrategy, do us a quick favor. Like this video, subscribe to the channel, turn on the notification bell so you never miss critical updates. Got thoughts on Cathie's take? Drop a comment below. Your insights help build a smarter investing community. Thanks for watching. Let's dive in.
I've mentioned before that there are some bears out there who really believe that we're going into an inflationary bust, much like we did in the 70s and early 80s. And they feel vindicated because you can see what's happened now to the S&P price relative to the gold price. It's beginning to look like it's breaking down, just like it did during the 70s. But there's a little bit of a contradiction here. The same bears on this basis have to face this chart, which is the S&P relative to oil. Now, as you can see in the 70s, this too collapsed, but it's not doing that right now. It's actually moving in the opposite direction. The gold price the oil price has been going down as the S&P has been flat to up in here. And so we have a contradiction. Now, we think that the oil price, which is coming down, is a massive tax cut, is going to feed into inflation, is going to be very good for the market, and that the ratio of the S&P to gold will reverse, that the gold price will settle down and the S&P price will go up relative to gold. Again, let's see what happens. We have an open mind on this. And if we're right, then we think that the global economy will improve and that metals to gold price in ratio will reverse. And maybe it will do so at the same time that interest rates are coming down as the Fed cuts short rates. Another indicator that keeps us honest here is these are credit spreads. It's the ratio of high yield bonds to the 10-year Treasury yield. And you can see low by historical standards, but starting to spike up a bit. And as you can see, this is what happens during recessions. It does spike, tends to go up before recessions, and then spikes during a recession. So we'll keep an eye on this one to see if this rolling recession turns into a rolling recovery and prevents a big spike. And then finally, always like to talk about Bitcoin to gold. And Again, gold going parabolic did take this ratio down. But you'll notice that it did not break the uptrend that is in place and that we think will remain in place. Bitcoin did act more as a risk-off asset. A risk-on asset in the market's recent correction. It behaved like the NASDAQ, unlike gold. But we believe that it was just correcting to this trend line because the Bitcoin price went up so much more than the gold price last year. So we think that this trend line will continue to move up if we're right that we're moving back into a risk-on environment. Now, the gold, why did gold act as risk-off, but Bitcoin not do so? I just described one reason. Bitcoin was way ahead of the gold price, so that is one reason. But I think the other reason is we weren't in a financial collapse. We were like 08, 09, and the banking system was or the counterparty risk in the banking system was not called into question. So we think the flight to safety into gold was more of a, hey, let's readjust and get this back into some kind of trend line. So with that, I hope I've conveyed we're really excited about how the market is beginning to shake off three headwinds: interest rates, convergence or narrowness of the market, and valuation. And we think that we're being set up here for some important surprises to the upside, as many strategists and economists worry that we're heading into a recession. We'll be talking more and more about the productivity-driven recovery that will spell the end of the rolling recession.
Cathie Wood then connects the dots to current political developments. The chairman of the House Ways and Means Committee has hinted at a push for a new tax and budget package potentially timed for a July 4th rollout, a move loaded with symbolic weight for the current administration. Why now? Wood points to growing signs of economic weakness. The latest GDP report showed the first negative quarter since Q1 of 2022, a clear signal of slowing momentum. If this trend continues, she suggests that political pressure to act will only grow, especially in an election year. That could mean faster moves toward corporate tax cuts or direct fiscal stimulus, as leaders scramble to stabilize the economy and boost voter confidence. Let's go back to the interview.
This is a very important slide. It illustrates the Laffer curve. When you cut taxes, if tax rates are too high, then the revenue actually will increase. Why is that? Because companies and individuals stop using tax shelters and stop trying to avoid taxes. I didn't say evade. That is illegal. I said avoid, figure out ways around the tax system. So here you can see the history of the corporate tax rate. And that is the black line there. And you can see over time what has happened. This goes back to the early 1900s, when we first put in place various income tax rates. And you can see there wasn't a good recording of tax receipts until the late 40s. But you can see how low the tax receipts were in the low 40s, how much tax rates have come down over the last 60, 70, 80 years, and corporate tax receipts going to all-time highs. And that's because lower tax rates do tend to stimulate growth, and there is less tax avoidance. You can see in the last Trump term, the corporate tax rate went from something like, well, I guess the maximum corporate tax rate went from 39%, and the average went from 35% to 21%. And in Congress, many people did not want that to happen because they thought that our deficit was already out of control, and this would make it worse. As you can see, tax receipts are up from the 2019 from roughly $200 to $500 billion. And of course, there was the COVID setback there, but so that somewhat distorts it. But tax receipts are up since we cut tax rates. And we think that the same will prove true with individual tax rates as well, especially, and I know this is politically sensitive, but the top marginal tax rate, if that were to come down, a lot of very high net worth individuals would stop using tax shelters. It just wouldn't be worth the legal costs and all of the complication. And so I wanted to show this chart because the chairman of the House Ways and Means Committee, which is where tax proposals start, he mentioned what has happened to the corporate tax rate as a setup for what they are going to propose in this budget. Now, President Trump and this administration generally would love to get a tax package and a budget put to bed by July 4th. I think that the Senate is thinking more like August. The House is thinking they can get something through in May. And I think that President Trump and his team are going to work aggressively to get something done by Independence Day. Lots of symbolism there. And so we'll see what happens. Stay tuned. One of the reasons we think that the odds of a tax package and a budget are increasing by July 4th is we're seeing some weakness in the economy. The GDP numbers came out this week, and we had the first negative quarter since the first quarter of 2022.
Despite growing fears of a looming recession from economists and market strategists, Cathie Wood and her team at ARK Invest are doubling down on their optimism. She believes we're not heading into a downturn. We're at the early edge of a productivity-led recovery, with interest rates likely to trend lower, energy prices declining, and credit markets holding steady. The conditions are forming for a surprisingly strong second half of the year. Add to that the accelerating pace of innovation disrupting legacy industries, and the setup, according to Wood, could be far more bullish than most expect. If you're looking for insights that cut through the noise, make sure to like this video, subscribe, and turn on notifications. Drop your thoughts in the comments. Is Cathie Wood right about what's coming next? Explore more of our content covering macro trends, crypto markets, and innovation investing, all right here on the channel.